Okay, in action. Yield curve dynamics, yield curve theory. The yield curve is basically upward sloping. When it's upward sloping like that, it's called normal. It's also called the term structure of interest rates. It's basically the interest rate or the yield to maturity associated with the maturity of the bond. So you can have different interest rates at different maturities for US Treasuries. And the yields to maturity or the interest rates are also called the risk-free rate. Bonds that mature less than a year are called money market instruments. Bonds that mature greater than a year are capital market instruments. The yield curve can shift up and down depending on aggregate demand and aggregate supply of bonds. So if there is demand for bonds across the curve, then bond prices are going to go up and interest rates are going to go down. If demand falls, then bond prices are going to go down and interest rates are going to go up. So again, if aggregate demand goes down, prices go down, interest rates go up. If aggregate demand goes up, prices go up, interest rates go down. If aggregate supply is pulled back, then prices go up, interest rates go down. If there's more supply than demand, then prices go down and interest rates go up. And that's basically the review. Then what we have is three types of curves and three theories. The first is the normal or upward sloping curve, which is an upward sloping normal curve. Then we have a flat curve. So as the Federal Reserve starts to sell off bonds on the short end of the term structure or the yield curve, bond prices are going to go down and interest rates are going to go up, and the yield curve is going to flatten to a flat curve. The curve could actually invert as the Federal Reserve is selling off more and more bonds, driving down bond prices and driving up interest rates. And remember, usually when the yield curve inverts, we usually have a peak in the stock market a year in advance, and then we go into a recession. Then the Federal Reserve starts to come back into the marketplace, starts to buy up bonds, bid up bond prices, and start driving down interest rates, flattening and inverting. So the Federal Reserve will, under a normal situation, start selling bonds, driving down prices, driving up interest rates to flatten the curve and invert it. Then once we go into a recession, the Federal Reserve tries to mitigate the damage of the downturn, starts buying up bonds, buying up bond prices, and driving down interest rates. And the Federal Reserve conducts open market operations on the short end of the term structure or at the short end of the yield curve. They do have an influence on the long end, but their main policy tool is to intervene through open market operations by buying and selling bonds on the short end of the yield curve, driving bond prices up and down, interest rates up and down to either stimulate or cool the economy. There are three theories: the expectations hypothesis, which is determined by the Fisher equation, which is nominal interest rate equals the real rate plus inflation expectations. Since real rates have basically been declining on a secular basis over the last 30 years, the major influence in moving interest rates up and down is inflation expectations. We are also focused on real rates of return. So you flip the equation, you have the nominal interest rate minus inflation expectations will give you the real rate. And if inflation expectations are higher than the nominal interest rate, then the real rate will be negative. That's good for lenders, that's good for borrowers, but it's bad for investors because they're getting a negative real interest rate. The two other theories, other than the market expectations hypothesis, which are related to each other, are preferred habitat and market segmentation, which basically states that issuers of bonds, people who borrow money from bond investors, either governments or corporations, prefer to borrow along the curve based on their preference, preferred habitat, their preferred maturity, which then ends up segmenting the market the bond market by maturity for investors. So there are investors who invest in the bonds, who lend money to the corporations and the government. There are corporations and government that borrow from investors along the curve at different interest rates, at different maturities. So the market is segmented. So corporations borrow and lend and invest on the short end of the term structure. There are other investors that prefer, in corporations and governments, that prefer to borrow and lend on the medium term of the term structure or the yield curve. And other investors like pension funds and endowments like to invest on the long end of the curve, and governments and some corporations like to borrow on the long end of the curve. So again, expectations hypothesis basically states that most yield curves are upward sloping due to the inflation expectations component, because those lenders of money want to be compensated by the deteriorating effect associated with inflation in the future. And then the market segmentation theory basically states, along with preferred habitat, is borrowers and lenders of bonds prefer to be at certain segments along the curve, depending on their capital requirements and capital needs. That's that, and then I'll go tie it into valuation, and then we'll go from there.